Get ready for a melt-up rally. That is what our next guest is calling for in the months ahead. He is Tom Lee. He is FundStrat's co-founder and the head of research, also a CNBC contributor. And as you see, he's here at Post 9. Nice to have you.
Great to see you,
Just
Scott.
saw Dietrich on. He's bullish. And you are too, but you say too many people are not.
Yeah, you'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here. What
role do tariffs play in all of the way you're thinking about the market?
Well, tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs aren't, we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if, for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah, I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, it's good for equities. But if this tax bill leads to more spending, even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be bad or it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off as that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, J.P. Morgan has a dashboard to the U.S. economy because they see consumer credit. They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon? And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah, I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly, but that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.
How many times does the Fed hike between now and the end of the year?
Well, I think you mean cut.
I meant cut. Sorry.
Okay.
I hope that wasn't a Freudian slip. Cut.
Yes. They may not do any cuts between now and the end of the year. But
that'd be fine?
Yeah, I think the stock market, now that we're in June, is starting to look at 2026. And I think the Fed's going to be, they're in a position to do cuts next year. That's what's going to be bullish for equity.
Lastly, still ride this tech run?
Yes, I think the Mag 7 were the first to peak, the first to bottom. They were the washed out stocks that didn't make new lows in April. So we like the Mag 7, but we also like this financials, industrials, and small caps for the second half.
Tom, why do you keep doing this to yourself? Last year, you said you like small caps for the second half. And you said they were going to go up 50% in the second half, or something like that, didn't you?
Yeah.
But why do you keep doing this to yourself?
Well, you know, the small caps have gotten hurt because the Fed has been on hold. It's been a hawkish pause, but I don't think the Fed's next move is to start raising rates. So, yeah, I know it's been not a great call, but I think small caps are still a second half story.
All right. We'll leave it there.
Thank you.
We'll keep checking back. Carl, thanks very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks not too far from all-time highs. At the same time, the economy showing some signs of weakening. We'll tell you what that's all about. We'll discuss and debate and how to navigate these markets with the investment committee. Joining me for the hour, Joe Terranova, Jim Leventhal, Sarat Saitsi, Bryn Talkington. Dow's going for a 5-day win streak. ISM non-manufacturing PMI below 50. That was notable. The lowest ADP print in more than 2 years, notable. Yields falling, something to keep an eye on. The president, once again, all over the Fed chair to cut rates. ADP number out. Too late, Powell must now lower the rate. He's unbelievable. Europe has lowered 9 times. At the same time, Joe, the president says it's extremely hard to make a deal with China's President Xi. You have the drama over the tax bill. You have the Musk versus Republicans on the Hill now. Ray Dalio on CNBC earlier today agreeing that the debt's a big problem. Nothing new from him, of course. He said, quote, "We're going to be in a period of greater than normal risk," citing a number of factors for that point of view. And yet the S&P is 2.5% from a new high. And I think our viewers care more about that than any of the other surrounding noise, I dare to believe.
I would agree with that. And everything that you're identifying is going to be featured on the next episode of how the market continues to move higher. Because in the current episode right now, the market is running off of a rebuilding of sentiment and positioning. And that is absolutely what is driving the market in the near term. What you've identified, the concerns that are in front of us, the concerns surrounding, absolutely, there is a hesitancy to transact. That was clear in the month of May. It is reflected in the services. It is obviously reflected in the ADP report. And tomorrow, we're expecting 130,000 jobs in the May report, down from 177 in the month of April. I think we're going to see that there as well. So in the near term, the market has the ability to move towards the all-time highs. I acknowledge that. But I do see in the third quarter, there is difficulty ahead, and it's related to an economy that is going to cool. And I've said this for the last several weeks. My biggest concern is not inflation, it is growth. And I am concerned that growth is slowing rapidly.
Well, and I guess you have to be concerned that the tariffs are the contributing factor or the leading factor as to why growth would be slowing. You know, I don't know what you guys think about what the future of the tax bill means to the future of the market.
I think it means a lot.
How are you thinking about that?
Here's my opinion, and we wrote this at Cerity Partners. It's up on our website. That the CBO, the Congressional Budget Office, which scores this thing, says it's going to be $2.4 trillion over the next 10 years, $240 billion a year in deficit increasing. But there's two things that are left out of that. One is the fact that the CBO does not do dynamic scoring. It doesn't take into account any economic growth that may come from this. We're of the opinion that there will be economic growth that comes from this.
Well, the other side of this equation, I'm sorry to interrupt you.
Are you going to steal my thunder?
I'm sorry to interrupt you, is that they also came out, because Megan Casello was doing this reporting earlier and saying that they said that the tariffs would cut the deficit.
Exactly. Thank you.
However, okay, let me finish, because there's a big asterisk by this second one. They say it would cut the deficit, the tariffs would, by $2.8 trillion over 10 years. So let's just call it a net zero. That is assuming, of course, that the tariffs are in place for 10 years.
Yeah.
Anybody believe that you're going to have tariffs in place for 10 years?
I hope not.
Well,
listen,
wait a second.
You're even debating that they could be?
No, I think, well, 10 years. I mean,
That's what they said.
I know.
That's what the scoring is based on.
That is what the scoring is based on. I mean, I think all of us on this desk and the ones who are not here today will admit that it's a difficult job to predict what the rest of this year is going to bring, let alone 10 years. We have to deal with the cards as they're dealt, and you just showed them to us, Scott, and that's what I was going to say is that right now in the month of May, tariffs ran at an annualized rate 190 billion more than a year prior. That's just a fact, okay? So that 190 billion up against the 240 billion of deficit increasing, again, not dynamically scored from the deficit. I call it a wash. Will it last? I don't know. I don't know if the tariffs will last, and I think, frankly, what I'd like to see before we discuss whether they last through next year's midterms is let's get them in place and move forward. This economy, this world wants to know what the rules of the road are, corporate-wise, investing-wise, and move forward.
It still leaves you, even if it is a wash, it still leaves you with the current state of the deficit, which is not good.
Okay,
not today, but tomorrow. The trajectory that
you want me to say the quiet part out loud?
Yeah, go ahead.
Yeah, the way you get out of this is not austerity.
You grow your way out of it?
You grow your way out of it. I mean, and I'm sorry, there's a little inflation involved in that too. That's the quiet part out loud.
Well, I mean, that's clearly their belief is that you can deficit spend your way out of it because you would ignite a level of growth that would eat into the deficit and get it off of this train wreck trajectory. It's not just a growth conversation. I mean, if you, like Jim, is probably more positive on the state of the economy than anybody on the panel, certainly today, then you must think that other areas of the market are going to work and get you to those new highs, even if maybe tech doesn't have to. It might.
Well, I think I'd take your words and I'd rephrase it this way. I think it's a stock picker's market. I mean, we often say that, but I do think, and we're all saying, I think the same thing, that the market will set a new high. Maybe it goes a little further. So, Scott, maybe we get a 5% rise from here in the S&P 500, and then it consolidates over the summer. I think you can find stocks out there that might do 10% in that environment. I've added to a couple of them today, Cisco Systems and Qualcomm. You know, Surratt was just mentioning about positive earnings growth. What I also look for, and I know Surratt does as well, is positive earnings revisions. Cisco, if you look at the earnings revisions, is definitely going higher, and it's with good reason. If you've listened to their last several earnings calls, they are definitely benefiting from AI, definitely benefiting from the data center build-out, and it's just not reflected in the multiple. With Qualcomm, it's a little bit different in that the earnings revisions are very slightly upwards, but they're being anticipatory, and I think those earnings revisions are going to start marching higher, not on the back of cell phones, which we all know waiting for this much heralded super upcycle is not happening, but where Qualcomm's going to really get the earnings revisions upward is in automotive and Internet of Things, the latter of which also does play into the data center build out. So my point being is that you can pick stocks and not have yourself involved with this discussion about whether the market's too high or is going to hit a new all-time high. You can pick stocks.
The payoff and all that, you didn't mention those two names by accident as we have on the screen. You bought more of both.
Yes, I'm sorry. I thought I said that, but yes, thank you for pointing that out.
That's what I'm here for.
Thank you,
Please,
Scott.
go ahead.
You know, I'll also
on.
Stacey Rasgon yesterday had a research note in which she called Qualcomm the Rodney Dangerfield of semiconductors, and that's they get no respect. I'm not sure everybody listening.
Qualcomm's one of our largest holdings, and it hasn't really gone anywhere. But what you're also getting through is this overhang period of every time people talk about, well, Apple's going to do this and Apple's going to do that, you're going to get secular growth out of Qualcomm in other areas that are not just dependent on Apple, and that's the thesis on that one.
You trim some Microsoft at the same time.
You got to find money with which to put the new money to work in Cisco and Qualcomm. And I looked at Microsoft; it's had a fabulous run. I still own the stock. I'm not saying anything terribly negative, but at 31 times forward earnings, I think it might be at fair price. So if I look for a source of funds, Microsoft is the one.
Amazon's target today in that group gets raised to 240. J.P. Morgan. Meta's target gets raised, J.P. Morgan, to 735 as well. So there continues, Joe, to be optimism, and a lot of it around these names. That, if analysts missed the last run in May, which was so significant, they're going to chase it up even further.
They are, but let's keep in mind, right now, of the 11 major sectors, technology is running in 8th place. I know recently we have a revival for semis and some of the Mag 7. But so far, year to date, it's been industrials, financials, utilities that are carrying the market higher. As it relates to the Mag 7, the strongest momentum that I see in the near term, and even if you pull back the calendar over the last year, is certainly with Meta. Meta is up 16% year to date. It's up 6% in the last 5 days. Sorry, Jimmy, I'm seeing very strong momentum for Microsoft, which is pressing towards an all-time high and looks like it wants to break out above there.
It's only 1% away.
Yeah, and you see, remember, positioning is so important in these names. You see rebuilding and positioning here in Microsoft because let's remember, it struggled. It had the relative underperformance last year versus the other Mag 7.
Well, let's just go through, Bryn, this downgrade today one more time from Needham on Apple. It's to hold from buy. They removed the $225 target, and they do it because they say, on a number of fronts, threats to Apple's near-term revenue and EPS growth. Every big tech competitor wants to take Apple's 15 to 30% platform tax. Gen AI innovations open the door for new hardware form factors that threaten iOS devices. And Apple trades at a forward year 26 PE of 26 times, which looks expensive on several metrics. Any one of those might be concerning. Taken in total, and there's the analyst who did it, Laura Martin. She's on the exchange at 1 o'clock today, so you can get more detail from that. But what about this call?
I think it's a little bit late, we'll say. The stock is not even near 225. But I think that the first point about the threats to revenue and earnings growth, like I cut half the position back in December because it's like, what revenue and earnings growth? The only earnings growth we've seen is because when their earnings per share come out, their per share number is lower. The denominator is lower because they're buying back so many shares. The challenge is there has not been revenue and earnings growth. I do think the app platform fee that they're charging, to me, that is the biggest risk because those services, that is a huge cash cow for them. I think what happened with Epic and with games, I think that is a risk in the name. And it's the 225 is actually its 200-day moving average. I think it's a good call, and I just don't see the catalyst to get this stock going again versus the other names like a Meta or an Amazon that you just like consistently are just running on all cylinders, moving in this direction and executing. This is a hardware company that to me has a software problem.
Citi, Sarat.
Well, this is in front of a breakup that's going to come, and you're going to get 3 different businesses. So all 3 businesses are good businesses. You'll get more value just owning it once they're broken up. So it's a good call, given kind of where the situation is in the stock.
Live Nation outperformed 185 at Bernstein, Joe?
I don't feel as good about Live Nation as I do about Spotify. The note that Bernstein talked about here is they mentioned superfans powering a group of stocks, entertainment stocks higher. Live Nation's kind of moving a little bit of sideways pattern.
What about Melius today turning more cautious on defense names? Jimmy owns Lockheed. The Joe T's got Northrop, Lockheed, and General Dynamics, and Sarat's got TransDigm. What do we think, Jimmy?
I think that, unfortunately, the world is a dangerous place and not getting any safer. And I think there's going to be demand, particularly with the change in stance from the U.S. versus Europe. There's going to be a lot of demand from Europe for defense products. They're not going to be able to supply them all internally. So companies like Lockheed Martin and the rest of the U.S. defense sector, I think, are going to benefit over the next several years.
What's this stock up over the last year?
Lockheed?
Yeah. I mean, even the ITA. Because, I mean, the world, I guess when people say, well, the world's a dangerous place, so it's good to own defense stocks. I mean, if that was, the world's always a dangerous place.
So, well, okay, my opinion is it's getting a lot dangerous, but that's okay. Let's not have that debate. I will say it's worth pointing out I bought Lockheed Martin in December of last year. It's relatively new. It went down to begin with. It's coming back. Now, it went down on those F-35 comments from Elon Musk. I don't know if everybody remembers them. Yes. I thought they were preposterous. I said so at the time, and I think the stock market is now catching up with that assessment.
Everybody, welcome to Blue Cloud Trading. This is a segment of the video where I'll go over the stocks that they just talked about on the halftime report. We'll also take a look at Tom Lee's recent ETF, GRNY. We're going to look at all of those, as well as the indices, the Mag 7 stocks. We're going to take a look at some member requests as well. And let's start off with the news here. You can see that Tesla stock down 3.55%, slumps as Musk ramps up attacks on the Trump's tax bill. basically quoting "kill the bill." Musk posted on Wednesday escalating tensions with the president as Tesla sales showed more signs of trouble. It was just a matter of time, I suppose, right? But before um, he got kicked out of the White House, I suppose. And so now the question is, how is Tesla stock going to perform? We're going to take a look at that stock in a few moments. We'll look at the technicals. Some of the other news today: stocks hum along as yields slide on the weak jobs data. Apple loses bid to pause App Store reform. Order in Epic Games case. Amazon delivery and logistics will get an AI boost. This doesn't look so good. Trump tax bill would leave 10.9 million more Americans uninsured. Let's see. Today's Trump trade has a catchy nickname. Okay. Tesla stock slides after more weak sales data as well. And Starbucks names Mike Grams an operating chief in top brass shuffle to boost business. Let's take a look at the how the indices did today. And you can see the Dow was actually down 0.22%, flat most of the day, and then it dropped. And then NASDAQ was up just 0.32, not a whole lot. S&P 500 was pretty flat at up just 0.01%, and the Russell 2000 was down 0.28. So I don't know what, on the show, they're really pushing the idea that the markets are like, doing unbelievably well here. As you'll see in a few moments when I get into the technicals, not so much. I mean, they're kind of stagnant for the last couple of weeks now. They're just basically stuck in the same zone. They haven't really moved. Here's the heat map. You can see that the stocks in the S&P 500, how they performed. Tesla was down 3.55%. The utilities were down. Energy was down, energy stocks. But Meta was up. Eli Lilly, Google, Amazon, Broadcom, Nvidia, Microsoft was up. Palantir was down 2.37. What about the sectors? You can see communication services and basic materials were the top ones, and utilities and energy were down the most today. But for the 1 week performance, technology is up, and then consumer cyclical is not so. It was up, but just slightly, 0.08. All right, let's get into the stocks. So we'll start off actually with the indices, and then we'll take a look at those CNBC stocks that you see right there on the left. Let's start off with the Dow, and we're looking at the daily chart here, as you can see. And like I said just a few moments ago, the market hasn't really been on a tear here. It's been for 3 weeks now, just going sideways. It's that's why we use technical analysis, so we can get a true assessment of what's happening, not what you hear. Okay, so always remember, as a trader, okay, don't pay attention too much to what you hear, but pay attention to what you see on the charts. The charts can't lie to you. They can't misrepresent what's really happening. But sometimes on the pundits on TV might do that. But the market here in the Dow, you can see it's just flat, just sideways action here. You get the Euro stocks also kind of flat right now, but they're stronger. Why? Because price is above the moving averages and the Ichimoku cloud. That's what we're using here. Japanese indicator. That's how you know it's bullish. If we go back to the Dow Jones, it's also, we've got a bullish cloud here. Price is still above the moving averages and holding up above that 200-day moving average. But if you look at the weekly chart on this one, it's inside the Ichimoku cloud, where the Europe stocks are significantly above the cloud. That tells us that there's a lot more momentum in the European stocks right now, and breaking through prior highs here on the weekly chart. How about IEV? That's the Europe 350 index. Very similar type of chart. You can see it was up 0.82% today. Here, that's a weekly. Here's a daily chart. Very nice, strong uptrend. Russell 2000 on the daily chart. Yes, it's looking good, okay, on the daily. Of course, like I said before, it's stalled here. It's kind of stalled here since, let's see, what's the date of this little candle? Monday, May 12th, okay? So 2 weeks, like I said. So it's been stalling at that 209.27 level. It's based on that prior high. It really needs to break through and get above that 200-day moving average before we can see a true move to the upside and a continuation. Right now, the fact that it's stalling is not a good sign. It doesn't give me hope that this thing is going to definitely, continue, basically. And here's the weekly chart. You can see the Russell 2000. I mean, you look at the longer term time frames, like the weekly charts, and they're not that positive. Prices under the cloud. Again, like I said, the FEZ stock, looks way stronger. All right, let's take a look at the QQQ ETF. Here it is on the weekly chart. This looks a little bit more bullish, but it's not that far away from its prior highs of 540.81. Okay, it's just another 2.3% away. Would I be jumping into this? No, right here. Wouldn't make any sense. It's too close to the target. And what's probably going to happen here, there'll be a lot of profit taking that takes place, and I'll be observing to see how price basically reacts, right, to the to this level here of 540.81. That's what I'd be watching. If it breaks through that level, then I could see a continuation of the upside. It's not like there's crazy amounts of positive news. You know, the geopolitical, you know, you get the war still going on in Ukraine with Russia, and the weaker sales numbers. I'm sorry, in Tesla, you got weaker jobs report. That was not good. It's not like things are like that great. I don't get it. It doesn't mean I'm not invested in this market. Like, I am a momentum trader. I'm more of a breakout trader. I'm looking for specific stocks, though, not these indices. The European one looks great, but the FEZ and IEV, but the rest of them are pretty weak, if you ask me. They've broken through some prior lows here, and so they're going to have to prove themselves, basically. The S&P 500, here it is on the weekly chart, like I said, and there's the daily chart. And the VIX, which represents volatility in the markets, luckily that's still declining. It doesn't seem like it's really, the volatility is really spiking anywhere here. It's just kind of stagnant, like I said, and it goes back to that Monday, May 12th, right? So like a few weeks now, 2-3 weeks or whatever. It is, it's just flat. All right, let's look at the stocks that they talked about on the show very quickly here. Cisco, and we'll start off with the weekly chart on this one. It's coming close to a resistance level of 66.50, which is just about 3% away. I'd hold off on that one. GRNY on the weekly chart. This is Tom Lee's ETF. They call it the Fundstrat Granny Shots US Large Cap. And this stock is also coming right to a level of resistance. As you can see, 21.34. I wouldn't be jumping in here either. It's a little bit extended above the moving averages here in the weekly. Here's a daily chart. You can see it's stagnant, just like the rest of the market. You know, I mean, pretty much the majority of the stocks are large caps, so they're going to react the same way as the S&P 500 probably. Honeywell International, one of the stocks they talked about, on the daily looks pretty strong. You can see that price is above the moving averages, above the cloud, above the 200-day moving average here. And you got the Chico span. That's today's closing price projected 26 periods into the past. And when that white line is above the candle 26 periods ago, that's very bullish. So that's very good. You get a bullish cloud. Cinco span A is above Cinco span B. And so I like Honeywell on the daily, but what does the weekly look like? So it just recently, for the last 4 weeks now, well, actually I take that back, 6 weeks now, it's been above the Ichimoku cloud. But, you know, the question is, you know, the moving averages here, you get the faster moving average on the weekly is still under the Kijinsen, the slower one. The 9 is under the 26. On the weekly chart, you got a bearish cloud here still. That projects in 26 periods into the future. So I don't think we are at a buy point quite yet, all right? So I'd hold off on Honeywell. I like to look for confluence personally in 2 time frames, both the weekly and the daily. And we don't have it on both time frames. But the stocks that I cover on my members-only videos always do. And so you should consider becoming a member. And if you haven't subscribed to the channel yet, folks, please subscribe, hit the like button, and share this video with someone. It really does help to get the word out, you know, about the channel so we can keep bringing these videos to you. ITA is the Dow Jones U.S. Aerospace and Defense Index Fund. And this one's been on a tear on the daily chart. As you can see, very strong uptrend. Has not even, you know, just briefly pierced under the 9-period moving average right there. But basically bounced right above it and then continued. So that's a nice little move there on the ITA. Let's look at the weekly chart. You can see multiple weeks now that it's doing quite well. Once it broke through, again, this is why I'm more of a breakout trader. I'm looking for breakouts. When you break out through consolidation, you've got a higher probability of a move up. Okay, and that's what we're experiencing here with ITA. What about LMT? That's Lockheed Martin. On the weekly chart, not looking so good. It's under the Ichimoku cloud. I'd hold off on that specific stock. Here's the daily emerging recently above the cloud, but it's that 200-day is still declining and price is under it. So I wouldn't be jumping here, jumping in this. And we don't have confluence on both time frames, like I said. LYV, Live Nation, on the weekly chart is above the moving averages, but the faster moving average is under. We don't have a perfect trend here. You can see what the reason why that is because price created a lower low from this low. And now it's pulling downwards, so it could potentially be creating what's called a head and shoulders pattern, which is bearish. So you can see here's the shoulder, there's the head, comes down, creates a second shoulder over here, okay, and there's the head. Now, so that's bearish, and as I've said before, I'll show you the pattern real quick for those of you who are new to the channel or maybe not familiar with these patterns. This is what it looks like, head and shoulders. You get that prior high that's lower than the middle, and then the second high that's lower than the middle one. So you get the shoulder, the head, and the other shoulder. And if it breaks under a prior low, like the number you can see right there, that's very bearish. So let's take a look and see where that prior low is. It's right here at around 113. So that's what I would be watching on the weekly chart. Here's the daily chart, though, showing a little bit of strength, but still under the 9 period. And then QCOM on the weekly chart, start off with that one, is above, hold on. It's under the cloud, very bearish. I'd hold off on QCOM. There's the daily if you want to see it. Not looking that great either. It's under the 200 and just barely above the cloud. I mean, it's not a terrible chart on the daily, but I don't know if I'd be jumping into this one with the 200 lingering right there. You know, it's about 6.7% away from where we currently are. Okay, and let's see. We're going to look at the Mag 7 real quick. Microsoft on the weekly chart is stuck right there, right under the 468 level. So I'd be concerned here. Like I said, there might be some profit taking, but if we break that 468.35, I think a lot of good things can happen here with Microsoft. There's the daily chart. NVIDIA, looking good on the daily. How about the weekly chart? Not terrible, but you get a bearish cloud and you get the faster moving average under Kijinsen. We're only about, well, we're about 7.5% away from this target of 152.89. So I'd certainly, if you have a position in this, you could certainly hold on and see how it can, if it continues to move up to that level. But be careful when you get that 152.89, basically. Here's Google. Let's look at the weekly chart. It's inside the cloud, okay? So that's not a good sign. You don't want to be adding positions when price is inside the Ichimoku cloud on the weekly or under it. On the daily chart, it's showing a little bit of strength here, popping its head above the cloud, but it's not there yet. As far as I'm concerned, you got 200 right there, waiting above. How about Tesla on the daily chart first? Is above, but you can see it's pulled back now. Did it break through this low? Let's find out. The low here was 331.39. It did not break under that level yet. So 331. And you can see that the price closed, right? It closed right here at 332.05. So just barely holding up. If it gets under that level, though, I foresee trouble. Amazon on the weekly chart first. It's above the moving averages, above the cloud, but we've got a bearish cloud in the future. So it's not a great chart on the weekly, but the daily looks more bullish here. As you can see, price is above the 200. The 200 is starting to incline now. That's a very bullish sign when you see it going from flat or declining to you can see, if I just draw a little line right here under this, straight across, see how it's inclining just slightly right there? Okay, so that's good for Amazon. We'll see what happens. Apple on the weekly chart first is under the cloud, so not a good time to be adding. Daily time frame inside the cloud, no, on Apple. Meta on the weekly chart is looking more and more bullish, but it's stalled at that 668 level. That level is a daily level. Let's look at the daily chart. It's based on this prior high right here, okay? Now that's a target. And I'm not sure how price is going to react tomorrow, but if it can break through that 668 level, expect it to move up to 740. That's the next level up, or next level of resistance, and that's about 7.33% away. So Meta's starting to look a little bit better on the daily, but again, on the weekly chart, we broke through these lows here in the past. There was some weakness that created it. It broke the structure of the trend, essentially. The tariff stuff situation, once those were announced, it kind of broke the whole structure of this beautiful move up that you see here that goes back all the way to 2022, November. Meta's up about 674%. So, but in recent weeks, as you can see, it has been moving up. So we'll see if it can continue. Here's a monthly chart if you want to look and see what that looks like. It's, still very intact, but those are the 2 months where it temporarily dropped under. So we're just getting closer to the prior highs. Let's see what happens there. Okay. And we're also going to take a look at members' requests here. EOSE is one of the stocks. This is a monthly chart. Not looking good on the monthly. It's under the cloud on the weekly chart. It is above the cloud, but under the moving averages. And you can see this big drop that happened yesterday. Let me see how big of a drop was that. It was about 30%. Yikes. I'm sorry, I take that back. Last week. That was a 30% drop last week, folks. This is a weekly chart. What's the daily chart look like? Yeah, you can see that. Everything started to fall apart once it got into the 9-period moving average there. You can see right there from that point, it's dropped 41.66. So this is a stock that you have to be, I would only consider day trading something like this. And it's not something that I would actually day trade that much because of the fact that you've got a lot of gaps here. The profit margins, if you're gonna day trade, I'd probably be shorting this more than anything else. I wouldn't be buying EOSE. Based on the operating cash flow that I see here is negative. Profit margins are negative 3,206.38%. Yeah, not something I'd be interested in. How do you deal with it if you're holding a position? Let's look at the 2-hour for a moment. Ooh, man. Yeah, I wouldn't be holding this position personally, but everyone's got to choose how they want to trade. Maybe you have a different system than I do, but based on the technicals of Ichimoku, I wouldn't be recommending EOSE. What about GDE? This is another request from our members. All-time highs, up over 24% this year. I wrote this note a little bit earlier today. So yeah, it's here we are, January, of 2025. You can see that nice move up. It temporarily broke under, but held above these low. See that low right there? Held above it. It never broke through that. And now it's continued to move up. It's looking like volume is coming into this stock too. This is called the Wisdom Tree Efficient Gold Plus Equity Strategy Fund. It's an ETF. So there's the weekly. Here's the daily chart. Nothing negative to say about it. On the daily, it looks very good. I mean, it hasn't even broken through that Tenkan-sen since it broke through here. So since that point, it's moved up 12.59%. All right, let's look at the next one, which is IDV. This is the iShares Dow Jones EPAC Select Dividend Index Fund ETF. Okay, so it's had a nice run. I will say that on the weekly chart. Actually, I see these purple lines. These represent monthly levels. So let's look at those on a monthly chart first. And let's go back in time a little bit so I can show you why this is listed right here. So if you go back to 2020, you can see that price came to that $34 level and had a major drop. Okay, came right back to that level. What happened? It dropped again. It almost dropped as far as to the prior low. All right, and then it moved up temporarily. It was just kind of like stagnant for a little while, now showing some strength. But where is it stuck? Right at that level. And so would I be getting in here? No, just based on the monthly levels are extremely powerful levels, especially when price is right under it. Here's the weekly chart. I'd be taking profits here. And you can see that what's going on here as price has been moving up, right? See price has been moving up here. What's been happening to volume on the way? It's been dropping on the weekly chart. So week after week, there's less and less people getting interested about it. Plus, look how far away you are on the weekly chart from the equilibrium zone, which is the 9 period and the 26. You're so far away. You know, I think that it's more likely to pull back. Maybe we'll come back by, allow the Tenkan Kijun to move up, the moving averages, find a little bit of support. Then maybe it can break through, and it will be a little bit more, I think, a concisive move. So yeah, I would not be jumping in. Here's a daily chart on this one. Yeah, so you can see it's very strong, but it's starting to slow down here, and just kind of getting stuck at that level. So wait and see. Now, if it breaks through, and you want to trade it based on the daily and the 2-hour time frame, you certainly could, and make that 35.93 your next target. And that's, you can make another 5.27%, because that's how far away that is from where you currently are. And that's also a monthly level. So again, going back to the monthly chart, it's based on that prior high right there. Now, once you break that one, the next level is actually 41.11, so that's pretty nice. You're talking about a good 17% move. So we'll see what happens with this one, the Dow Jones Select Dividend Index Fund ETF. Guys, that's going to do it for this video. A couple of things I want to say before I go. I am on vacation right now, so I'm keeping these videos relatively short. And you can see that this is my page, my homepage here for Blue Cloud Trading. If you're, a lot of you guys are just viewing these videos, but it really does help the channel if you hit that subscribe button. Okay, then it gets sent out to more people, and the more people that subscribe, the more videos I can produce. It gives me motivation as well. It's free to subscribe. Hit the notification bell. If you want extra content, you can click the join button as well, which is right next to it, and it will pop up, and there'll be a little thing that pops up here in a second. There it is. And you'll see there's 3 tiers to the membership. You've got Blue Cloud Supporter, Blue Cloud Trader, and Blue Cloud Legend level membership. And you can see the different prices for each one. $4.99 for that one. Blue Cloud Trader is $24.99. And you can access the exclusive member-only videos under this level, Blue Cloud Trader. Under Blue Cloud Legend, you can access those exclusive member-only videos, day trading videos I've recorded that you can view, and I also do daily trade updates on my entire portfolio. And I post those updates. I'll show you exactly where you can find them. Once you become a member, there'll be a new little tab that pops up here. It will say membership. So let me show you what that looks like. It will look like this. And you click on that, and that's where you'll find those updates. All right, that's going to do it for this video. Like I said, thanks for watching, everyone. Appreciate you. I will catch you all. Oh, one more thing. And where do you find those videos? If you go, again, if you just kind of scroll down right here, this is the member-only videos. You can hit the play all button, for example. You can go back this way, and you can find more and more videos. There's a day trading video, for example. Someone was asking where to find those, but this is, if you click on this, play all, you'll find the entire list right there. And if you want more links, like the software that I use, TC2000, which is this software right here, which is great. I recommend this. You get a $25 coupon with the link that I have in here. So let me show you that. Click on the 9 more links right here. Scroll down. There's the link, $25 coupon for TC2000. You click on this right here. There's other links in there too, by the way, that you can check out, like my X page, Blue Sky page, a couple of other ones. This will pop up. This is the software, TC2000. It's been around for decades, this company. And you add your email right here. You download it for Windows if you want, or if you can run it on Mac if you have Parallels, if you want to download it. But you can also use the web version. And here's the pricing. You click on pricing, software plans, and data, and you can see that if I select monthly, it's for the silver, it's $9.99 a month. For gold, it's $29.99 a month. So like you can get the silver for 2 months for free. Doesn't have a lot of features. Okay, you won't be able to draw on the charts or get alerts or anything like that. But if you want just a basic bare bones software just to play around with it for free, you can do that with the silver for a couple of months. Otherwise, try the gold if you want to get the full effect of the software and pay $5 out of your pocket, because it's $29.99 a month for 1 month. You can try it out. And then once you're ready for the next level of platinum, There's even more features here. You also get discount $300 per year if you open a brokerage account through TC2000. They've partnered with Interactive Brokers, so most of the trading takes place through Interactive Brokers platform. It's called the IB Smart Routing, and so you can find out more information about them here. Anyway, that's all, guys. Have a great rest of the day. I will catch you all in the next video.